What is going on, investors? Hopefully, guys are doing well out there. That is right. It is earnings season, and we're kicking it off with bank earnings. We're consolidating them all in one video. I think that works better for most people. Today, we're going to talk about JP Morgan, which reported last Friday. We're going to talk about Bank of America and Wells Fargo. All have reported their earnings. All will have timestamps down below if you want to jump to the individual name that interests you the most. And we have markets and these financial stocks soaring. And I think as we go through this video, you're going to see why. These are fantastic results, even after Jamie Dimon, the CEO of JP Morgan, really tamped down expectations last week. Now, let's kick things off with JP Morgan. Year to date, this stock is down 28% over the last year. Basically paints a similar story with this one. The company reported their Q3 earnings last week. Revenues came in at $32.7 billion. That was up 10% year over year, and it beat expectations by about $840 million. We'll get to more of the details of the financials here in a moment, but some news items as it relates to JP Morgan when they reported their earnings. Again, this was last Friday. They had an earnings beat. They plan to do buybacks next year, and they boosted their net interest income guidance. Obviously, as those interest rates continue to tick up, that certainly will benefit a company like this, especially if they stay elevated for a long period of time. The other thing that we're seeing is not a lot of impact from the consumer yet. Obviously, we've had near double-digit inflation running for almost a year now here in the United States and across the world, and consumers are still wearing and handling this thing pretty well. Credit card delinquency rates were just 0.69% in September. That was up a little bit from August when they were 0.66%, and they were 0.64% a year ago. So under 0.7% delinquency rate on those credit cards over the last year. You might be wondering, well, what was it before we had this whole pandemic? Well, they were actually 1.14% in February of 2020. So they're still well below historical records. Now, in terms of that net charge-off rate, it was 1.15% in September. That was the same as August and up from 0.94% back in September of 2021. But these charge-off rates were actually 2.2% in February of 2020. So we're just still seeing delinquency rates and charge-off rates still historically low over at these companies. Now, what's not historically low at JP Morgan is the fact that they're on pace to do some pretty solid revenue growth in terms of quarterly earnings over the next couple of quarters. Wall Street has this pegged at kind of a mid-teens grower, which is absolutely unbelievable for the next 3 quarters. That will head you into 2023. Finally, by the Q3, you're going to go back to a mid-single digit, and then a year from now, expected to be about flat on that revenue growth perspective. I think it's 2 things. The reason why Wall Street has JP Morgan kind of pulling back on that revenue estimate. Number one is most estimates from the Federal Reserve is the fact that they'll pause on interest rates. And in fact, many have them actually pulling those interest rates back, actually lowering those interest rates sometime next year. The other thing is they are boosting their net interest income over the last couple of quarters at JP Morgan. As interest rates are ticking up, they're not necessarily doing that on the deposit side. So they are getting more on those loans, and they're not really paying the depositors that much more. Over time, they'll have to balance that out a little bit, and that I think could impact revenue for JP Morgan. Now, what's interesting about JP Morgan is we're looking at a pretty historically good time to accumulate this stock. I've got a 10-year price to tangible book. This is if you were to liquidate every single one of JP Morgan's assets, you're basically paying 1.5 times the asset value that JP Morgan has on the books today. That has historically been a decent time. Now, this stock has gotten close to about 1 times tangible book over the last 10 years, but it has traded in excess of 2 times tangible book. And I tell you what, if these interest rates, if you're of the belief that interest rates will stay high, they won't necessarily pull them back, they certainly won't go back down to quote unquote zero. Well, I tell you what, the book of business over at JP Morgan probably in very good shape, because I think we'll see evidence of that when we get to these earnings. These are fantastic. Okay, here was that $32.7 billion worth of revenue. That was 10% growth year over year. It was 7% growth quarter over quarter. Your non-interest expense came in at $19.2 billion. That was 12% growth year over year, but just 2% quarter over quarter. So you grew those revenues quarter over quarter by 7%, and your interest expense drew just just 2%. Your provision for credit losses are significantly higher than they were a year ago. Last year, we actually released $1.5 billion of credit loss provisions back onto the balance sheet. This year, we're taking away that $1.5 billion, and it is actually up quarter over quarter. So Jamie Dimon, his comments just a couple of weeks ago, I think saying something like winter is coming, really spooked the markets, really spooked JP Morgan stock as well, but you wouldn't see it by these results. Yes, they are setting aside more for credit losses, but boy, this revenue looks nice and they're controlling their expenses as well. Take a look at your net income year over year. Yes, it is down 17%, but most of that has to do with the fact that you got a credit for $1.5 billion in credit losses this year. You actually had a debit on that side. So net income coming in at $9.7 billion. I think more importantly, is quarter over quarter, you're up 13% on that. That's fantastic. You earned over $3 per diluted share. Let's go through some of the key business segments over at JP Morgan. Here's your consumer and community banking. This is basically the largest and most recognized business over at JPM. Your revenue in that segment coming in at $14.3 billion. That was up 14%, both on a quarter over quarter basis, but also a year over year basis. Now, what I noticed here is you have this home lending. Look how this has fallen off the map, down 34% year over year, quarter over quarter, even down 8%. Now, obviously a negative thing for JP Morgan in terms of their business, but probably a good thing for the overall macro economy when it comes to inflation. Obviously, that inflation part when it comes to housing and rents has really been driving the CPI report. We really do need housing to start to cool off. And the fact that we're seeing massive cool offs here, we'll see evidence of it when we get to Wells Fargo as well. Even greater evidence that those housing and home lending certainly impacted by those higher rates. But what isn't impacted is the credit cards and automobiles. Those are up 9% and 7% respectively year over year and quarter over quarter. That gave you net income in the most recent period at $4.3 billion. That was basically where you were at a year ago in the consumer banking business, and it's up a whopping 40% where you were just a quarter ago. JP Morgan doing a very, very wonderful job in that segment of their business. Now, their second largest business is this corporate and investment bank. Very steady, okay? Small declines year over year on that revenue side, but they still were able to churn out $3.5 billion worth of net income. That includes about $513 million set aside for credit losses. That in comparison to last year when they actually got a credit for $638 million. All things being considered, very steady on that side of the business. Now, finally, commercial banking, that was up tremendously, 21% year over year from $2.5 billion all the way up to $3 billion. What we saw here was a little bit more provision for credit losses quarter over quarter, you went from $209 million all the way up to $618 last year. You had a credit of $363 million. So that really impacted your net income. Despite the 21% growth on that net revenue, your net income actually was down 33% because you had some non-interest expense go up about 14%, but also these credit losses really ballooned. So you have net income in that segment of the business coming in at $946 million, which is very comparable to the previous quarter, but down tremendously a year ago when you were at $1.4 billion. So a little bit of push-pull over at JP Morgan, but I tell you what, their two largest business, these consumer banking especially, looking incredibly strong. The consumer itself looking incredibly strong and resilient. Certainly, there are consumers and there's people out there struggling, but I tell you what, not a lot of them have a bank account over at JP Morgan. Now, in terms of the stock performance, it's been down big. Obviously, we talked about it at the top of the show, down about 30% over the last year or so. But based on those results that we see here, I think you can comfortably go ahead if you already have a position in this one or you want to start a small position in this one. I really don't mind picking some spots here in the 115, 120 range. If this is where the stock decides to hang out, they're going to resume their buybacks next year. Charge-offs and delinquencies on the cards are still really, really low. And from a valuation perspective, which we talked about at the jump, is relatively attractive from a price to tangible book value. JP Morgan looking pretty good. Not necessarily a stock that I would center my entire portfolio around, but if you want some financial exposure, this would be one I would definitely add. Moving on to Bank of America. This stock reported their earnings today, year to date. This one's down 27% over the last year, paints a similar story, down 25%. This company reported their earnings today. Revenue came in at $24.5 billion. That was up 8% 8% year over year, and it beat expectations by over $1 billion. This company is still seeing consumers just deposit money in their bank account, up more to $1 trillion in deposit. That was up 68 billion, or about 7% year over year. We are seeing consumers pile more money onto those credit and debit cards, up 9%. Certainly can be something that could provide some risk into the future, but if we do have a semi-soft landing, well, I tell you what, that could be a nice little tailwind as those consumers carry a little bit of balance at higher interest rates. Now, Bank of America's Q3 earnings topped those consensus estimates on higher interest and higher and strong consumer balances and even loan growth over at Bank of America. We'll take a look at that here in a second. In terms of those revenue estimates coming forward for Bank of America in the upcoming quarters, we're looking at kind of not as good a growth as we saw with JP Morgan, where they were kind of mid double digits. This one may be going into double digit territory sometimes next year, but relatively strong growth rate, looking at least mid single digits for the foreseeable future for Bank of America. Now, from a valuation perspective, similar price to tangible book as we saw with JP Morgan. Now, obviously, if you missed that, tangible book is if you were to liquidate all of Bank of America's assets. This is the price premium that you're paying to it. So obviously, if you were at a 1 times price to tangible book, you're basically paying $1 for $1 in assets. When you're paying 1.5 times, which is about where Bank of America is, you're obviously paying a small premium. But obviously, you tend to do that for companies that perform relatively well. Now, this company has traded more recently as high as a little over 2 times tangible book. Certainly not be an area where I'd want to accumulate this stock. It's been lower 5, 6, 7 years ago. We were close to 1 times tangible book. It's rare that you see a Bank of America, that you see a JP Morgan get towards that 1 times tangible book. Certainly underneath it is a great buying opportunity, but it's certainly been more overvalued more recently. Not the worst price if you're accumulating Bank of America stock. Now, we see these net interest yields. I mean, last year at this time, you're about 1.9%, and now they've ticked all the way up to 2.5%. If you are the belief that interest rates are not only going to continue to go up, maybe just inch up, they might not have I don't think anybody's anticipating the rapid rise that we've seen over the last 6 months with the Federal Reserve raising these rates. Well, if they can raise them just a little bit more and then hold them there, that would be very, very, very beneficial for these companies. As you see, this net interest income just continues to climb as these interest rates climb, because what these companies are doing is particularly Bank of America and JP Morgan, basically all the companies that we're reporting here, they're not giving you that much more attractive interest rates on your savings and your checking accounts like a SoFi does and some of these other smaller banks and the upstart fintechs that they're doing. They're attracting you at 2.5, 3% kind of savings rates. Well, Bank of America and JP Morgan don't have to do that, okay? At least in the shorter term, they're going to hold kind of those rates relatively low, and they're going to cash in with loan growth, and that's kind of what we're seeing. Now, the other thing that we're seeing over at Bank of America, which kind of defies a lot of logic, obviously you tune into the news and you're seeing inflation and you're seeing people struggling. Well, the people have Bank of America bank accounts not really struggling, because you see here, the average consumer bank deposit balance still remains above pre-pandemic levels. Yes, they've kind of flattened out and maybe gone down just a little bit, but people still have money in their bank account, believe it or not. Now, moving over to the financial results over at Bank of America, we're going to look at consumer banking to lead off with. This is the largest business segment at Bank of America, $9.9 billion worth of revenue. I tell you what, year over year, fantastic growth. They were at 8.8 a year ago, and just last quarter, they were at 9.1. I just can't believe this. They're actually seeing loan growth over at this company, even as you had these interest rates continue to take up. Take a look at average loans and leases, 2.8 billion last year, or excuse me, 280 billion last year, all the way up to 295 billion. That's on the average loans and leases. They just continue to tick those up. And then, like we talked about, average deposits right here on the top, those went from 1 trillion last year all the way up to 1.69 trillion, a year over year growth. Now, month over month, a little bit of decline there, but nothing very significant. They are setting aside more money for those provisions for credit losses at Bank of America, $738 million in the most recent quarter. Last year, just $247. Last quarter, just $350. So they basically doubled those quarter over quarter and nearly tripled them year over year. So there is some risk there that money has to be taken out, but it also could be a tailwind if the consumer with their $1.69 trillion worth of assets decide not to be delinquent or default on their loans and credit cards. Well, that is money that will later be returned to Bank of America. Non-interest expenses, doing a really nice job at Bank of America. Just about, we'll call that $5.1 billion last quarter, just at $5 last year, $4.6 million. So they're doing a nice job over there at Bank of America, not seeing a lot of non-interest expense like we're seeing maybe at an Amazon or a Walmart. That led to really strong net income at this company. Again, this is just in the consumer banking segment, coming in close to $3.1 billion. Last quarter is 2.9. Last year, basically about where you're at, shade over $3 billion. Now we come down to global wealth and investment management, total revenue coming in at $5.4 billion. This is a very, very steady business. The non-interest expense stayed relatively the same. The credit loss is relatively the same, at least quarter over quarter, year over year, up significantly, but nothing particularly tangible when it comes to Bank of America. And your net income right at $1.2 billion. Last quarter, it was basically the same. Last year, similar type of thing. Your deposits are basically flat year over year. Now, quarter over quarter, down a little bit, but nothing really alarming. And your average loans and leases up pretty significantly year over year as well. Your global banking in terms of revenue, basically flat. Your non-interest expenses, basically flat. Your net income coming in at $2 billion, down a little bit year over year, but most of it has to do with these provision for credit losses. And then your average deposits, they are down year over year, relatively significant, and just about flat quarter over quarter, but your loans and leases are up from $324 up to $384 billion. This company, I can't believe it, with these interest rates rising across the world, people are taking on more and more credit. Finally, your global markets business, basically flat from a revenue perspective. This is a very, very steady business. Net income basically steady. Average total assets up year over year, down slightly quarter over quarter. So we saw that across all lines, from the global, from the corporate, all the way down to consumer. Quarter over quarter, we're seeing a small decline in those total assets. Now, some of it has to do with equity values and those types of things falling down. Some probably small drawdowns in when it comes to savings and those types of things. That is something that we would actually expect. What I didn't necessarily expect is these average loans and leases just continue to climb year over year, quarter over quarter. Businesses and consumers just continue to take on more and more credit. Obviously, with things costing more, so probably makes a little bit of sense as well. Things, your cars, your homes are costing more, so the average loan of those types of things continue to trend up. So we're not really seeing a lot of demand destruction, at least when it comes to loaning. That could be somewhat of negative when it comes to CPI, when it comes to inflation. You'd probably like to see a little bit more demand destruction from the loan side of things, but obviously we'll see how those things play out when those CPI reports come out every month. Now, what I've identified with Bank of America, we are on a weekly chart here. We've got it going back to the depths of not quite the great financial crisis. That was back here. This was like a $2 stock there, but you had kind of a lot of people were afraid of what was called a quote double dip recession back in 2011. It created actually a really nice buying opportunity for a lot of stocks, Bank of America including. We've basically been in a pretty long uptrend since then. We more recently bounced off it of the 30.5 level basically just a couple of days ago. Now we're up above this trend. I do have a green box on here for a long-term sideways consolidation. You basically had 5 years of price consolidation with Bank of America between about 22 and where the stock is right now at about 33. I'm not as big a fan. If you're choosing between Bank of America and JP Morgan, and certainly we could throw Wells Fargo in here in a second, we'll show you their technical chart pattern when we get to them. But if it's just a choice between JP Morgan and Bank of America, I'm probably going JP Morgan. And many of you are probably like myself, you actually have positions in both of those companies. I'm adding to JP Morgan because from the technical chart perspective, looks a little bit better from that traditional valuation metric as well. When we looked at that price to tangible book, while they both trade at about 1.5 times tangible book, JP Morgan has a little bit higher upside in my opinion. Obviously, we're kind of splitting hairs a little bit. If you want to just slowly continue to add to Bank Bank of America your position. Certainly, most of us are doing that through dividend reinvestment, as Bank of America, it's got about a 2.78% yield. I think JP Morgan is higher. I'd probably tip the scales for JP Morgan, but you get a pullback in Bank of America back to this longer term trend line, which is really only $2 or $3 lower than where it is. That'd be an area I'd be more comfortable with when it comes to Bank of America. Now, finally, we're going to take a look at Wells Fargo Company. Over the last year, this one's actually only down 2.9% year to date, though. It is down about 13%. This is after reporting their earnings last Friday on the same day JP Morgan did. Their revenue coming in at $19.5 billion. A relatively slower growth rate, certainly when it compares to Bank of America and absolutely JP Morgan, growing just 3.6% year over year. That did beat expectations, though, by about $720 million over at Wells Fargo. Those Q3 earnings definitely were helped by those higher interest rates. And again, those higher interest rates, they have to hold. We can't see them go up and then all of a sudden the Fed pivots and they're like, oh no, we got to go back down to 0%. That would definitely negatively impact the banks to a certain degree. Wouldn't be like these stocks would crash. They obviously performed relatively well. Even Wells Fargo performed beautifully over kind of a low interest rate environment. But obviously the longer those interest rates can stay, not quote unquote high, they don't have to keep going up. But if we go up to like 3, 4, 5, 5.5%, and then maybe we come back, but we only come back down to like 4.5% or 3.5%, somewhere in that range, that would be very, very beneficial for these banks because they've really built their businesses over the last decade, basically in a zero interest rate environment. So if all of a sudden they can have a spread of 2, 3, 4% over the deposit rate, well, yeah, these banks are going to be doing very, very well the longer that rate can stay in that positive territory. But they were also hurt by litigation costs at Wells Fargo. That obviously is something been hanging over this company's head for a long period of time. Now, from a price to tangible book value, out of all of the three, this is the quote unquote cheapest, trading at just 1.24 times tangible book. So you're only paying 0.25% over premium on this one. That's a pretty low premium. Historically, like the other banks, this one can get close to 2 times tangible book. That is a time to sell, in my opinion, when you're looking at most of these banks. Certainly over the last 10 years, that's certainly been the case with Wells Fargo and with Bank of America and JP Morgan. When it gets under that 1 times tangible book, where you're basically getting the book of business at a discount, that is when you want to load up on these types of companies. But they all pay a dividend for the most part, and they're all growing that, and they're all doing share buybacks for the most part. So inching into these stocks, even when they're historically kind of fair valued or maybe even slightly overvalued, not necessarily the worst strategy as well. It's just you really want to double down when these banks are in these really bad positions. Now, from an earnings growth perspective for the upcoming quarters, Wall Street has the upcoming quarter kind of looking kind of ugly, basically down or flattish year over year. But then we're going to reaccelerate into next year, kind of in a mid double-digit growth rate, and sustain that for a period of time until you get into 2024, where things are expected to go flattish for Wells Fargo. Obviously, for Wells Fargo, we get over here to the financials, you'll see a lot of that probably has to do with the housing market. This company actually would benefit greatly if you had a lot of people take out loans for, we'll call it maybe a 2 or 3 year period of time at a higher rate. Maybe people get their mortgages at 6, 7, 8%, and then all of a sudden you had those loan rates crash back down. That refinancing business certainly is really, really good over at Wells Fargo. Now, we're going to take a look at the consumer banking segment at Wells Fargo. Revenues came in at a staggering $6.2 billion. That was way up just from a quarter ago, where you're at 5.5 and up huge. We're talking 29% year over year growth from 4.8 up to the 6.2. What crashed though was this home lending side of the business. Look at that, down 52% year over year. You had $2 billion last year, all the way down to $973 million. That housing market, while I don't necessarily think we're going to see an overall crash, at the very best, that is going to flatline. And I think for the overall economy, it actually would be really good if homes, first of all, if they could just stay flat for several years, or we could see a decline. That would help inflation. It would help people that are struggling paycheck to paycheck. It would help your wages go a lot further. It would help new homeowners get into new homes. Younger people with less salary and less wealth built up get into home ownership. While it's nice to own a home like me and probably many of you out there and watch the paper value go up, it does nothing for the economy, and actually it probably hurts your wealth more than it helps it. We're seeing an increase in credit cards, up about 8% year over year, 3% quarter over quarter. Automobile loans, those are basically starting to go flat, if not down. That's not surprising to me, considering a lot of used cars and new cars are priced pretty healthily. And now we're starting to see 6, 7, 8% interest rates on those. And then finally, personal lending up 9%. That's a pretty small business for Wells Fargo, but can be a sign, a small sign, that consumers are under a little bit of pressure as they're taking out personal loans. Those provision for credit losses, well, they set aside quite a bit in the most recent quarter. Nearly $1 billion. It was just $613 million a quarter ago. Last year, they actually got a credit of $518 million. So it's up 277% year over year. Obviously a tailwind for this quarter, but if things get a little bit better, they don't have to realize those credit losses. Those get released in a subsequent quarter down the road, and those really bolster up those net income numbers. Because you see in the most recent quarter, despite that 29% growth on that overall revenue side, again, this is just for the consumer banking for Wells Fargo, 29% growth on that revenue side, your net income was actually down 51% year over year and down 14% year over year. A lot of that had to do with the fact you had these provision for credit losses coming in at $917 million, and you had your non-interest expense go up quite a bit, quarter over quarter and even year over year up 12%. Last thing here is you'll see that those loans up 3% year over year, and those deposits actually up 5% and basically flat on a quarter over quarter basis. The consumer is just taking more loans, but they still are balancing those off with more and more deposits. Now, from the commercial banking side over at Wells Fargo, total revenue coming in at $2.9 billion. That was a whopping 42% year over year. Your interest expense, or your non-interest expense, just came in at just 9% growth year over year. So your net income very, very high this year, up 56% year over year from $760 million all the way up to $1.1 billion, nearly $1.2 billion, in fact. And your loans up 17% year over year, but your deposits actually down on that commercial banking side. Not sure what to make of that, but I tell you what, if I was a business right now, I probably would be pulling my savings and trying to reinvest and grow my business as the market remains incredibly tough. On the corporate and investment banking side of the business, net income basically flat year over year on relatively strong revenue growth. Those loans up year over year 19% and the deposits down 17%. So what we're seeing is actually businesses and corporates kind of pull their deposits, but that consumer still remains relatively strong across the board when we looked at all of these companies. Last thing that I want to show you is Wells Fargo actually shows you the tangible book value of their assets, coming in at $34 per share in the most recent quarter. Again, this stock trading closer to $44 per share. Now, from a technical perspective, this one's a little bit different. I'm on a weekly view. This big drop down here was the great financial crisis. We minus that, okay, we've really been in a range with this stock, and there's a couple of different ranges. The bottom of the range is down here at 24. Now, we haven't seen those prices since 2020, so it's been a little while. There's another area here where this red line is, about $37 per share up to as high as about $60 per share. Where the stock is right now at $44, not as attractive as certainly Bank of America, and not nearly as attractive as JP Morgan is, considering you're just $15 basically from the all-time highs that we made, or at least the more recent highs that you made on Wells Fargo just a couple of months ago. But like of all these stocks, this is a stock that pays a dividend. I think it's restarted its buyback, or it's going to. Adding to any or all of these stocks in small pieces, certainly not the worst decision, but I tell you what, the one that looks the juiciest looks like JP Morgan from a financial perspective. From a valuation perspective, it would probably go, for me, JP Morgan, like if I was spreading $100 across these three stocks, I'd probably do maybe 50% in JP Morgan and then equally spread the rest into a Bank of America and a Wells Fargo. That's just my opinion. That's how I see it. We'll be back later this week. We've got Netflix, we've got AT&T, and we obviously got Tesla on Wednesday in terms of earnings. We'll be back to cover it all here on the channel. Hopefully you guys have a great day out there. Good luck with your investments.